GPs who are thinking about doing a continuation vehicle because their funds are getting a little bit old and they're still healthy, but they want to continue on raising new funds for the platform. So they want to solve a little bit of an issue by helping their LPs get some liquidity. That is probably the most common conversation we've been having over the past year. The other conversations we're having are with the BDCs.
Hello and welcome to Liquid Courage. I'm David Snow, your host. And today we're joined by Ed Goldstein, Partner and Chief Investment Officer of Coller Credit Secondaries, and Eric Green, a partner at Upwelling Capital. Ed and Eric, great to see you and welcome to Liquid Courage. We're looking forward to talking to you about what's going on in the credit markets and the credit secondaries market. There's a lot to talk about. Credit has been in the headlines for good and for bad in the past few weeks. But first of all, Ed, we'd love to learn just a little bit more about you before we jump into the credit secondaries world. Please tell us something about yourself that you think people would be interested to know.
A common assumption about me is that I'm a New Yorker, but I'm one of the few people who is a native Floridian, born and raised South Florida. Most people end up there. Uniquely, I started there and moved north for my lack of good judgment.
You followed a reverse migratory pattern for your career in life. That's excellent. All right. Well, great to have a native Floridian with us here. Floridians are great at credit secondary investing. And so looking forward to diving in. Why don't we start with just a little bit of a history lesson on the credit secondaries market. The most mature secondaries market is in private equity. If you were to compare credit against the development of private equity, where would you say credit is?
It's still relatively early. The industry started pretty much when Jeremy started the firm, Coller Capital, back in 1990. There was a private equity market, which was probably less than 10 years old. The buyout firms really just starting to grow in size. And so a secondary market naturally follows that. The current era of private credit, which really started after the GFC, it's only maybe 15 or so years old. The biggest chunk of the market today is senior direct lending. And that really evolved pretty meaningfully starting, in 2012 and 2013. So today you've got an underlying market in private credit, which depending on how you define it is anywhere from $2 to $4 trillion. And the secondary component of that is still rather small. It turns over less than 0.5% per year. So it has grown quickly from in 2023, 5 billion of volume to then 10 billion to 20 billion last year. So it's a steeper curve because while it's a new asset class for secondaries, secondary technology itself has been around for a while. So what you're seeing is a newer market, but that's growing at an accelerated rate, which is creating a secondary credit market growing at a much higher rate than the underlying primary market.
Before we get into current market conditions, let's talk to Eric a bit. Eric, you are a credit market old hand, right? You have been involved in direct lending. From
old dog.
Old dog. Oh, sorry.
Yes, all right.
That's the preferred term. Talk about what you believe to be the most sort of notable transformations to that market as it sort of became a place where secondaries were taking place.
The big transition sort of pre-GFC to post-GFC were really focused on troubled funds, right? And so post that, that's been more what I would kind of call an on-the-run market. So it's performing credit, that ability to provide some amount of liquidity or rebalancing to managers as they build their programs. And that's certainly been the story with private credit. There's just been a substantial build out of programs. And so it's a necessary part of the market.
Why was the great financial crisis a catalyst for further growth in the credit secondaries market?
The biggest driver of what's creating the volume today is basically a shift of credit risk from bank balance sheets to commingled funds. When I think back to 2007, when I was in the direct lending world, I remember going out, trying to originate loans, knocking on doors, and the response is typically, wow, direct lending, this sounds really great, but wait a minute, you're more expensive than banks. It's very illiquid. Like I have banks lending me money really cheaply and giving me lots of leverage. And then when the GFC hit, that turned on its head, all of a sudden these banks were not there. The biggest takeoff from there came from these private credit funds. The allure of a private loan from a fund where it's a single manager who's arranging it, or maybe a a lead plus a small syndicate. It's a more intimate relationship. It's custom tailored for your needs as a borrower. If you do run into issues, you can have someone to talk to about giving you that relief or making short-term modifications to help you get through some hiccups. It just changed the nature of that borrowing relationship. And that's what really proliferated starting in 2012 and 2013. It's just accelerated very meaningfully over the course of the teens for what was perceived as a very low-risk product where you could get diversification, and also because it's being professionally managed by someone who's aligned with you as an investor in their funds. It's sort of stabilized now in terms of the mix between private lending and syndicated lending.
Let's talk a bit about the fact that the credit secondaries market has grown in large part because institutional investors have been allocating more and more capital to the private credit asset class. The latest Coller barometer report that has come out, which is a survey of investors, found that 42% of LPs said they expected to increase their allocations to private credit. That was the highest of all the asset classes. The lowest, by the way, was venture capital. Does that sound about right?
As you go back, into that post-GFC world, many pensions were well underwater below benchmarks, right? So many pension funds saw this idea of a pretty good consistent return somewhere in the high single digits without any additional leverage. You didn't need fund leverage to get to those returns, was attractive as it related to kind of hurdle rates. You're above your hurdle rate, you had diversification and those things. And I think that in parallel with the phenomenon that Ed mentioned where banks walked away from the market, that drove a lot of this growth. And now I think you've seen those lending businesses have gotten to pretty substantial scale. So they've also started to lend to bigger and bigger companies, right? Such that even at some point last year, you started seeing the likes of JP Morgan say, wait a second, guys, we want to be lenders too, right? And Goldman as well, where they're setting up their own platforms because they've seen market share go away.
What are the range of solutions when we talk about credit secondaries today? Obviously, on the private equity side, the more established traditional market, there's LP solutions, and then there's GP-led solutions. How would you rank the sort of solutions that are being used within the private credit market?
As with equity, it's LP-led and GP-led. And often people are selling for the same reason they're selling their private equity portfolios on the LP side. Rebalancing could be tax-related, regulatory-related. So, and oftentimes someone may be selling a portfolio that has both credit and equity in it, right? So on the GP-led side, some meaningful differences in that the credit is asymmetric to the downside, right? So it's not like in private equity where the early GP-leds in private equity were, funds that were in trouble or zombie funds or tail ends. Today in private equity, the biggest part of the GP-led market is trophy assets. In credit, obviously doing a single asset deal makes no sense because you need diversified portfolios to make the product work. Our funds, you have thousands of lines in them. So even if we're underwriting a GP-led transaction, we need to take that into our portfolio construction considerations in terms of how much exposure we want. A GP-led in credit would typically be something more along the lines of, let's say you've raised a multi-billion-dollar fund, maybe it's 6 years old or 7 years old. So it's through its investment period, but it's been heavily recycled. And maybe some of the loans have been extended because you love the credits, you don't want to get refinanced out. So that fund may still have 25% of its capital left and still be in pretty good shape. But your LPs maybe thought when they invested, okay, if it's a 7-year fund, I'll be pretty much out by year 7. But, actually, there's still like 25% of my capital left. And my manager, who I love dearly, is now 2 funds ahead and is asking me to put money in. So the conversation is, okay, so you've generated a pretty nice yield for me, but you've still got all these loans in the fund. And if you want me to come into fund 5, can you do something about fund 3? And because most of the loans have repaid and there's been a nice yield, the overall return of the investor is still pretty much the same from inception because they've maybe gotten 75% of their capital back, but it allows them basically to move on. You then take that fund and rewrap it in a new vehicle, put a fresh credit facility on that. Maybe you top it up with some dry powder. If you're an existing investor, you can stay in if you want to. To give you a statistic, the amount of capital that sits in private credit funds that are over 5 years old today, it's close to $500 billion. So there's just a ton of that out there. And a lot of it is really good stuff, right? It's not just like bad stuff sitting in old funds. There's plenty of that. There's plenty of good stuff out there. So that's also helped catalyze some of these GP solutions. And so what you've seen is a market which 2 years ago was probably 80% LP driven, whereas today it's probably closer to 50-50. A lot more GPs started showing up and saying, hey, I'm in the same situation. Can you tailor something that works for me and my investors?
If we look at the private equity secondaries market, there's probably two reasons, broadly speaking, why a portfolio company would not have exited the portfolio. Either one, it's not doing very well, or it hasn't met certain expectations of certain parties. Or two, and this goes to the GP-led side, it's doing so well that it's a trophy asset and the GPs want to hold on to it longer. In a credit portfolio, you mentioned good reasons why they'd want to hold on to these loans or maintain the credit lines. Are there other reasons why there's so many outstanding assets in these funds that have not yet been liquidated?
In a PE fund, typically you make an investment and it exits, right? You don't recycle the capital. A lot of private credit funds, particularly direct lending funds, they could invest themselves 130%, 150%. You make a loan the first year of the fund, it repays in year 3, you make a brand new loan. And so suddenly you're at the end of your investment period with a brand new loan. And if you've done this over and over again, even though your fund is 5 years old, maybe 6 years old, the average duration in your portfolio is longer than you might have thought it would be, or an LP might have thought it would be. So the nature of how these funds have been deployed is just different than what happens on the PE side. So that's why you could sell a portfolio that's reasonably fresh. There are loans that will go bad. And one of the great things about our market is that we see what's in the portfolio. We see the lemons. We see how they're going to ripen. We can underwrite them. So if we are buying a fund that has, pick a number, let's say 15% of it is watch listed or where you can see credit deterioration, we can underwrite that and price that in. I'm willing to pay X for this portfolio because this part of it is super clean and I can pretty comfortably forecast loss rates on this bit. There's also segmentation in the market in terms of levels of risk appetite that players will have.
Wouldn't you also say that it's a bit manager specific, meaning that some managers you'd say have a better skill set background in managing through tough credits, and others are more guys that just do regular way credit and probably don't have as much a capability to perform in those tougher credits?
Yeah, absolutely. You take syndicate checks and deals, right? So you have no control over what happens. Whereas if you're always a lead lender and you have a robust platform and you have a history of taking over companies when they need to get taken over instead of letting them rot, that factors into the view on what recoveries could be. So absolutely.
What is the Coller team's appetite for distress? How many of these hairy assets would you be willing to underwrite and under what circumstances?
We have one pool of capital that's focused on senior performing credit. Some portfolios might have some distress in them, but there's a low tolerance for that.
To your point, Ed, I think many of the larger credit secondaries firms, as they have bigger pools of capital, have also discrete pools of capital that can address different opportunities from a risk perspective.
According to the Barometer survey, about 20% of LPs think that GP-led credit secondary solutions will become mainstream tools across credit funds. Well, you could say it's only 20%, or you could say, wow, it's 20%. Which is it? Let's start with Eric.
I think you could see a meaningful uptick in that as we get to the back half of this year. And it really is, to a large extent, has to do with those more mid-sized firms that I think are going to increasingly struggle to raise capital and are going to need to reach out to secondaries players to create that, if you would, bridge of money to hopefully get to the next fund. We've also seen in the market for CVs that there's still a high failure rate broadly in CVs, right? Not just within private credit. And that's because I think investors are getting more and more selective. They're getting more picky about quality. And like anything in the capital markets, as things start to take off, which CVs have, you've started to see a lot of stuff just come in. And we think in private credit, what you'll see is there's going to be some of this that won't work. The firms won't have the performance or the returns or the characteristics that are going to work for Ed and his peers. And I think that's where you could see some amount of struggle with firms, really kind of probably more 27 and 28.
More than half of what we're seeing actually is GP-led activity. We'll see what the failure rate on those is. Some of them are very good quality. Some of them are less good quality. We're not excited about doing transactions where our capital is what's going to save them.
Obviously, you are assessing the health of the underlying credits when you are looking at a potential opportunity. How much attention do you pay to the capabilities and the structure of the GP group itself? Would there be any situations you would walk away from because you felt that the skills of the manager or the incentives of the manager weren't quite there?
Absolutely. If you've got a manager who is either thin in that capability, if they have a history of being slow to act, that's also a reason why we would take a pause. If they play more of a participant role in transactions where they might have a vote but not really be able to do anything, that gives us a bit of pause. Also, from an incentive standpoint, and this comes into play in GP-leds, we also want to see that they have real skin in the game. So if they're doing a GP-led transaction where they are moving loans into a new fund where we're becoming an investor, we want to make sure, A, that they're also rolling their commitment and any of their incentive comp they've earned into the new deal to make sure that if we heard, they heard also. But also, to the extent they also own those loans in other funds across the platform, that also creates strong alignment that it's for the benefit of all of the funds they're managing across the platform.
In the current market, what is the most common, I guess, recurring theme? Or, your phone rings and there's an opportunity on the other side and it follows a pattern that's very much of the moment. What does that type of situation look like?
I mentioned this $500 billion that's sitting in funds over 5 years old. GPs who are thinking about doing a continuation vehicle because their funds are getting a little bit old and they're still healthy, but they want to continue on raising new funds for the platform. So they want to solve a little bit of an issue by helping their LPs get some liquidity. So that is probably the most common conversation we've been having over the past year. The other conversations we're having now are with the BDCs. What's really interesting is the bigger pain right now is more of a liquidity issue. The credit issues that you're hearing about are relatively idiosyncratic. There's not like this massive credit deterioration. Health is generally good. You might see some of these Amazon aggregators you've heard about. Okay, that's a specific part of the market that's collapsed. And so some funds have exposures to those. Maybe 18 months ago, people were talking about these doctor roll-ups that were done during a lower rate environment where people took on lots of leverage. So you've had pockets, in the market that have had issues, but your bog standard corporate credit is just fine. The software scare is one that, we are spending time on. Maybe a fund is overexposed to it and people are digging in and saying, okay, how fast is AI going to impact these credits? How much of it is a revenue loan versus a company with real cash flow? So some of those are things that need to be investigated, but the market's sort of been painted with a broad brush that all software is going to hell. That's not true. The liquidity issue that a lot of these BDCs are facing are the fact that, particularly the private ones, they are semi-liquid products. Very clearly, they are stated as semi-liquid products. I think there's just been a lot of people thinking that, okay, semi-liquid means liquid, and it's not. If you believed, or someone told you that, hey, you can get out whenever you want, that's just incorrect. The reason why they are semi-liquid products is because private credit is illiquid. And having something that is a truly liquid underlying vehicle matching with an illiquid asset doesn't really work. So the semi-liquid funds, they're designed to protect from fire sales and to allow for orderly liquidation. And so in many ways, the market is functioning the way it's supposed to, but it's generating a lot of headlines that are causing noise and creating fear, which is unfortunate. Now, look, could that be good for us? I'm not going to say yes or no, but look, we're having a lot of interesting conversations.
Yeah, and I would just note, having spent myself some time around BDCs, the public BDCs are actually permanent capital vehicles, so they don't have liquidity issues. They just have market value challenges. And if you look through the cycles, by the way, if you go back in 2000, a lot of the well-regarded BDCs were trading, at substantial discounts, 30, 40% or more to NAV, and then they bounced back. So I think, as Ed noted, the real liquidity questions around these, what we call private BDCs, that are mostly actually raised through retail, predominantly. They're not really an institutional product. And that's where you have gates, right? So it's very similar to what you'd see in hedge funds, right? Where hedge funds frequently have these similar kinds of gates associated with them.
Since both of you are obviously credit experts, have you been getting questions from people who are perhaps well outside of the credit world? What kind of questions do they have, and how do you explain what's going on in the BDC market?
The institutional investors, they ask questions, but there's no panic. It's just like, hey, this is super interesting. What are you guys doing about it? We're getting a lot of questions about BDCs, about software exposure, the general health of credit. There may be funds that have taken excess risk. And so what this often does call out is there are a few names in the news. If someone has like 3 or 4 of the names, then it gets a lot more questions. Like, is it coincidence? Is it credit selection? Is it right? So it's a lot more exciting than saying, hey, 99% of the market paid its interest today. Like, there's no story around that.
Opportunistic investors are certainly putting this in the front of their radar screen for certainly the first half of 26, that there should be a lot of opportunity. They certainly perceive that maybe there'll be investors that need to unload portfolios, to Ed's point, which are broadly good quality, but at sort of fire sale prices. And having been around, as I mentioned, the old dog back in '09 out doing a lot of this, those windows are pretty narrow. We're certainly not in anywhere close to that period, just like Ed mentioned. I do think we're also seeing larger institutional investors, though, that are looking to obviously have a program to commit primary money to the space, continuing to move up market with, again, larger managers. What the challenge may be for a lot of mid-level private credit managers, it will be increasingly hard to raise funds as you move through 26 on a primary basis. So I think Ed, he's already probably a very busy guy right now. He's only going to be more busy as we get to the back half of the year, because those mid-sized firms are really going to struggle, we think, in raising primary money. So they're going to need to access the secondary markets.
I'm not going to disagree with you.
Sticking with the BDC world for just a bit longer, Ed, what would be a smart play that one could make in the slightly dislocated BDC market right now?
There are a lot of BDCs, not all created equal. Buying a high quality BDC, private BDC or non-traded BDC at a discount should be an attractive trade. The magnitude of the discount, TBD. Fire sale in credit might be different from fire sale in equity. Are you going to find the best quality BDCs trading at 30% discounts? No, I don't think so. You've seen some news about some hedge funds tendering for shares in some of these entities at pretty steep discounts. I don't know what the take-up will be. I would say first start with quality. If you can get that at a reasonable discount, it's probably a better trade than buying something that's poor quality at a steeper discount.
The phenomenon that we have seen is that, as Eric pointed out, managers that may have trouble getting to their next regular fundraise might get a continuation vehicle to sort of free up some capital for some LPs and get them to that next fundraise. At the very highest end of the private equity world, these largest managers with the big brand names are having less trouble raising capital. It's the medium-sized and the smaller managers that are going to face headwinds. Is that a similar pattern on the private credit side?
You could be a middle market or lower mid-market lender, but still have a robust platform and good track record. So even though you're lending to smaller companies, you're well set up versus someone who's maybe raised a couple of funds off the back of a bit of a rise in the market. And those are the guys that I think will struggle first, where you don't have a multi-fund track record or built depth of platform because you were sort of along for the ride. There are hundreds of middle market buyout funds, right? But there are some that are very good and very niche and very specialized, and those will do well. But if you're sort of just another one, like, you don't want to be called sort of just another middle market fund, right? That's when you know you're in trouble.
Jam bug. Nobody wants to be a jam bug.
Yes, I have heard that term.
Ed, what makes you continue to feel bullish about being part of the private credit secondaries market? What makes you wake up and say, hot damn, this is a great opportunity?
My 6 months ago answer is, depending on what math you use, there's between $2 and $4 trillion of this stuff out there. And that even in a regular way, normal course trading of a liquid assets market, there's going to be a need for liquidity for all the same reasons as PE. We're so well positioned to buy that stuff. And it's not super exciting generally. A lot of it's just vanilla credit, but mass diversification, sleep at night, solid yield, good returns. Like, it's such a deep market. It's going to continue to grow. We love that. And our investors should feel very good that those funds, they've got great risk adjusted return. They'll perform well year in and year out, regardless of the environment. The answer today is take all that vanilla stuff, and there's a little bit of whatever you want to call it, hot fudge or caramel that's coming. And there may be the opportunity in the near term to earn some excess return. When we first started raising our dedicated fund and people said, well, how is this a market? And it's easy to look back now and say, well, of course it was obvious. But at the time we first started raising capital, it was maybe less obvious to people that this is going to be a market. And again, putting aside the current noise, this is just a natural function of what's happened with the growth of another private asset class.
If there's some headwinds that are going to be there for private credit, I think the secondary funds are going to definitely be the beneficiaries of that. So there'll just be more deal flow, more opportunity to be selective and really drive value for investors.
Excellent. Well, this is an amazing topic, the secondaries opportunity in the credit market. But for now, we'll say goodbye. But hopefully, Ed Goldstein from Coller Credit Secondaries, we'd love to have you back in the future. And of course, Eric Green from Upwelling Capital, a partner to the Liquid Courage podcast. Great to see you and looking forward to having you on future episodes. Thank you.
Great. Thanks for having me.